Let us begin with a profound and uncomfortable truth about the modern financial system. The vast majority of people participating in the stock market are not actually investing. They are playing a high-stakes video game designed by Wall Street to separate them from their capital. 90% of retail investors treat the stock market like a globally sanctioned casino, and they treat the stocks they purchase like rented lottery tickets. They are, in the truest sense of the word, renters. To understand the renter mindset, you have to look at how they interact with their portfolio. A renter logs into their brokerage app and sees nothing but a ticker symbol, 3 or 4 random letters blinking on a glowing screen, accompanied by a line chart that glows neon green or violently red. Their entire emotional state, their financial confidence, and sometimes their very sanity are dictated by what those arbitrary letters do between the hours of 9:30 a.m. and 4 p.m. If the line on the chart goes up, they feel a rush of dopamine. They feel like absolute geniuses who have finally cracked the secret code of wealth. If the line goes down, they feel physical pain. Panic sets in. They scour social media and financial news networks for reasons why the line is falling, and eventually they succumb to a desperate urge to sell just to make the bleeding stop. They rent the stock, hoping to pass it off to a greater fool for a few dollars more before the lease expires. Warren Buffett, the architect of Berkshire Hathaway, and arguably the greatest capital allocator in human history, recognized early in his career that this is a fundamentally rigged game. Wall Street algorithms, high-frequency trading firms, and institutional supercomputers will always beat you if you try to play the renter's game. They have fiber optic cables physically closer to the exchange servers. They are faster than you, they have infinitely more capital than you, and crucially, they do not feel human emotion. Wall Street thrives on your activity. The entire financial media ecosystem is built on a model that requires you to transact. They need you to buy, sell, trade, panic, and switch your strategy constantly because that is how they generate attention, flow, and ultimately, fees. They will blast you with breaking news alerts, dramatic downgrade warnings, and terrifying macroeconomic forecasts designed to make you feel anxious and inadequate. They desperately want you to believe that sitting still is the most dangerous thing you can do. To win this game, you must step off the casino floor entirely. You must stop playing by their rules and walk into the boardroom. You must fundamentally rewrite your psychological wiring and become an owner. When Warren Buffett buys shares in a company, whether it is Coca-Cola, American Express, Apple, or a railroad, he doesn't think to himself, "I hope this stock goes up 10% by next month so I can lock in a quick trade and beat the S&P 500 for the quarter." He thinks, "I have just purchased a fractional piece of a massive global distribution network, a fortress-like consumer brand, and a compounding cash-generating machine." Think about this in the context of your own neighborhood. Imagine you pooled your life savings and bought a highly profitable local coffee shop or an auto repair business. How would you evaluate your success? You certainly wouldn't hire an erratic man to stand on the sidewalk outside your shop every single day, shouting out random, wildly fluctuating prices at which he is willing to buy your business from you. And you definitely wouldn't sell the shop to him in a panic just because his offer on a Tuesday was 20% lower than his offer on a Monday. Instead, you would look at your operating metrics. You would ask your general manager how many cups of coffee you sold this week compared to last year. You would evaluate your labor costs, your utility bills, and the wholesale price of raw coffee beans. Most importantly, you would look at how much actual cash was left in the register at the end of the month after all the bills were paid and the taxes were settled. You would judge the business by its fundamental economic reality, its cash flow, and its competitive position in the neighborhood, not by the daily, uninformed opinions of strangers. That is the fundamental shift. You must train your brain to view a share of stock not as a piece of paper, not as a digital blip on a Robinhood screen, but as a legally binding claim on the future cash flows of a real, breathing, living enterprise. If you are going to act like an owner, you cannot simply buy any business. You have to buy exceptional businesses. To truly understand how to think like an owner, we have to look at how Warren Buffett himself evolved as an investor over the decades. In his early days, studying under his legendary mentor Benjamin Graham at Columbia University, Buffett practiced a strategy known as cigar butt investing. He would scour the dusty pages of Moody's financial manuals, looking for companies that were priced so incredibly cheap on the stock exchange that they were trading below their actual liquidation value. Imagine walking down the street and finding a discarded cigar butt on the sidewalk. It is gross, it is ugly, and no one else wants it. But there is still one good, free puff left in it. Buffett would buy these dying textile mills, streetcar companies, and obsolete manufacturers, take the one free puff of profit as the market corrected the pricing error, and then throw the business away. But as his capital base grew from millions into billions, this strategy became mathematically impossible. You cannot scale a portfolio of dying, capital-intensive businesses. It was his longtime business partner, the late Charlie Munger, who forced Buffett to change his entire philosophical framework. Munger taught him a rule that would define Berkshire Hathaway forever. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. What makes a company wonderful? It is a concept Buffett coined as the economic moat. In medieval times, a castle was protected by a deep, wide ditch filled with water, and sometimes alligators, to keep invading armies out. The wider and deeper the moat, the safer the castle. In the brutal world of free market capitalism, every highly profitable business is a castle. The moment a business demonstrates high profit margins, competitors, the invading armies, will constantly try to storm the gates, steal the customers, undercut the pricing, and destroy those margins. An economic moat is the structural, durable competitive advantage that protects the business from this relentless assault. Moats come in several distinct forms, and an owner must know how to identify them. The first is the ***. Brand moat ***. Coca-Cola is, at its chemical core, essentially just water, sugar, and carbonation. Anyone listening to this video could mix a cola beverage in their kitchen tonight, but no one can replicate the century of global psychological conditioning, the advertising legacy, and the ubiquitous distribution network that makes billions of people specifically reach for a red Coke can when they want a refreshing drink. The brand is the moat. The second is the ***, switching cost moat, ***. Think of a massive enterprise software system integrated into the daily operations of a global hospital network or a multinational bank. Even if a flashy new startup comes along offering a slightly better, cheaper software alternative, the pain, financial cost, operational downtime, and sheer risk of tearing out the old system and retraining thousands of employees is so catastrophically high that the customer simply stays put. They are locked in. The third is the ***, network effect. Moat ***. This is where a product or service becomes exponentially more valuable as more people use it. Visa and MasterCard possess arguably the greatest network effects in financial history. A merchant has to accept Visa because every consumer has a Visa card in their wallet. Consumers must have a Visa card because every merchant in the world accepts them. It is a closed loop of immense power that is nearly impossible for a new competitor to disrupt. When you think like an owner, Your primary job before allocating a single dollar is to identify these moats. You aren't looking for a company that is going to have a surprisingly good earnings report next quarter. You're looking for a company that possesses a structural advantage so profound that it will remain virtually unassailable for the next quarter century. To find these wide moat castles, you cannot rely on the opinions of talking heads on television. You have to speak the native language of business. That language is accounting. An owner naturally takes an interest in corporate financial analysis, specifically the interpretation of income statements and financial reporting metrics, because they know that the numbers tell the true, unvarnished story of the company's competitive position. Let's tear down the financial statements exactly the way a business owner does, starting with the heart of the operation. The asterisk. Income statement. Asterisk. You always start at the top line. Asterisk. Total revenue. Asterisk. It is incredibly exciting for retail investors to see a company growing its sales by 20, 30, or 40% a year. Wall Street praises hypergrowth, but a true owner knows a critical, sobering secret. Revenue is vanity, margin is sanity, and cash is reality. Revenue is completely meaningless if it costs the company too much money to generate it. Selling a $1 bill for 90 cents will generate infinite, explosive revenue growth, but it will eventually and inevitably bankrupt you. So, we immediately move one line down and calculate the asterisk. Gross profit margin asterisk. This is your revenue minus the cost of goods sold. COGS, the raw materials and direct labor strictly required to manufacture the product or deliver the service. If a company consistently maintains a gross margin above 40% over many years, it usually flashes a massive, blinding buy signal to an owner. Asterisk. Pricing power. Asterisk. Pricing power is the ultimate, undeniable indicator of an economic moat. It means the company has a product so essential, a service so sticky, or a brand so dominant that they can raise their prices during periods of severe macroeconomic inflation, and their customers will complain, but they will absolutely still pay. If you look at companies that have survived and thrived through decades of economic turmoil, market crashes, and inflationary spikes, they all possess high, remarkably stable gross margins. But we don't stop there. An owner aggressively analyzes the operating expenses, specifically zeroing in on charcy, that's G&A, selling, general, and administrative expenses, asterisk. This line item is the corporate cholesterol of a business. This is where you see if the management actually respects your money. Are Zgonda costs consistently eating up 70 or 80% of the gross profit year after year? If so, you are likely looking at a company with a bloated corporate structure. Maybe they have layers of unnecessary middle management, overly generous stock-based compensation packages for underperforming executives, or a corporate culture that prioritizes luxury headquarters and private jets over operational efficiency. As an owner, you want to see a lean, hungry, ruthless operation. You want a company where the costs of basic administration are tightly controlled, proving that the company does not need to constantly burn cash just to maintain its current market position. When you read an income statement with this level of scrutiny, you aren't just blindly crunching numbers in a spreadsheet. You are playing financial detective. You are looking for the permanent financial footprint of a compounding machine, while the income statement shows you how much money the business made over a specific period of time. The asterisk balance sheet. Asterisk tells you the structural health and survivability of the company at an exact moment in time. A renter almost never reads a balance sheet. They find it boring. An owner obsesses over it because the balance sheet dictates whether the company can survive a catastrophic economic shock. The balance sheet is simply a list of what the company owns, assets, and what it owes to others, liabilities. The difference between the two is the shareholder's equity. That equity is your money. When evaluating the balance sheet, an owner's eyes dart immediately to the asterisk. Asterisk long-term debt. Asterisk, asterisk. Wall Street loves debt because leverage amplifies returns. If you borrow money at 5% interest to fund a project that yields 10%, you look like a financial genius. But leverage is a violent, double-edged sword. It amplifies losses just as quickly, and more importantly, it introduces the existential risk of total ruin. Warren Buffett famously avoids companies that require massive amounts of debt to maintain their daily operations. He knows that in business, just like in life, you only have to get rich once. Why risk everything you have and need for something you don't have and don't need? A company with a pristine balance sheet, loaded with cash reserves and carrying very little long-term debt, is virtually bulletproof. When a recession inevitably hits, when credit markets suddenly freeze up and banks stop lending, the over-leveraged competitors go bankrupt. The business with the strong balance sheet doesn't just survive the storm, it goes on the offensive. It uses its mountain of cash to buy up struggling competitors for pennies on the dollar, emerging from the recession far stronger and more dominant than before. To verify the reality of the balance sheet and the income statement, the owner turns to the ultimate truth serum of accounting. The asterisk asterisk. Statement of cash flows, asterisk asterisk. Net income on the income statement can be legally manipulated using accounting tricks, depreciation schedules, and adjusted earnings metrics. But cash flow cannot be faked. The money is either in the bank account or it isn't. An owner focuses obsessively on asterisk asterisk free cash flow. The actual, tangible cash left over after the business has paid all its operating expenses and all its required capital expenditures, the money needed to maintain the factories, servers, or equipment. A business that generates massive, consistent free cash flow is a machine that controls its own destiny. This leads us to the most important mathematical metric an owner can calculate. Asterisk asterisk. Return on invested capital. ROIC. Zagend. Imagine two very different businesses. Business A makes $100 million a year in net profit. Business B also makes $100 million a year in net profit. To a casual renter, they look exactly the same. But the owner asks the critical question: how much capital did it take to generate that profit? If Business A is a heavy manufacturing company that requires $1 billion of machinery, blast furnaces, and inventory to produce that $100 million of profit, it has an ROIC of 10%. Not bad, but capital intensive. But if Business B is a software company or a famous franchise brand that only requires $200 million of capital to generate that exact same $100 million of profit, it has an ROIC of 50%. Business B is infinitely superior. It is a capital-light compounding machine. It generates massive amounts of excess cash that does not need to be plowed back into the business just to keep the lights on. Once you have scoured the financial statements and found a business with a wide moat, high gross margins, manageable debt, and exceptional returns on invested capital, you might think you are ready to buy. But you are missing the most critical, unpredictable human element. You have to evaluate the people running the machine. This introduces the biggest risk for an absentee owner in the stock market. Asterisk asterisk. The agency. Problem. Asterisk asterisk. You are the legal owner of the business, but the CEO and the executive management team are merely your agents. In a perfect world, your incentives would align perfectly. But in the corporate world, they rarely do. A renter-minded CEO wants to build an empire. Their ego demands that they run the biggest company in the industry, not necessarily the most profitable one. They want to make massive, expensive, headline-grabbing acquisitions to get their face on the cover of Forbes and Fortune. To fund these ego trips, they will often take on dangerous amounts of debt. Or worse, they will issue millions of new shares of stock, quietly diluting your ownership stake. They want their compensation tied to the sheer size of the company's revenue, regardless of how much shareholder capital is destroyed in the process. An owner-minded CEO operates in a completely different universe. Their primary job is not just running the daily operations. Their primary job is capital allocation ***. Capital allocation is simply deciding what to do with the excess free cash flow the business generates every single year. A great CEO looks at $1 billion of cash flow and asks, "What is the most intelligent, highest returning thing I can do with the owner's money today?" First, they look for internal reinvestment. If the core business is generating a 20% return on capital, the CEO should pour every available dollar back into expanding that business, launching new products, or opening new locations. But what happens when the business becomes so massively successful and large that it can no longer reinvest all its cash efficiently? This is where management is truly tested. A poor management team will take that excess cash and desperately buy unrelated, mediocre businesses just to keep growing top-line revenue. A brilliant management team will return the cash to you, the rightful owner. They can do this in two ways. The first is a straightforward cash dividend. They mail you a check every quarter, allowing you to decide how to reinvest your portion of the profits based on your own financial goals. The second way, and Warren Buffett's absolute favorite method, is through ***. Share buybacks ***. When a company's stock is trading at a fair or cheap price in the open market, the management team can use the company's cash to buy its own shares off the stock exchange and permanently retire them. Think of it like a pizza. If you own one slice of an 8-slice pizza, you own 12.5% of the pie. But if the company uses its profits to buy back 4 slices from other people and destroys them, there are now only 4 slices left on the tray. You still hold your one single slice, but magically, mathematically, you now own 25% of the entire pie. Your ownership percentage, your claim on all future earnings, and your voting power have all doubled, and you didn't have to spend a single dime of your own money or pay a single cent in taxes to make it happen. Share buybacks are the quietest, most tax-efficient, and most powerful way to compound your wealth over decades. But they only work if management is disciplined enough to buy the stock only when it is undervalued. If they buy back stock when it is wildly overpriced, just to prop up the share price for their own executive stock options, they are destroying your capital. Evaluating management's track record of capital allocation is the invisible dividing line that separates the casual gambler from the true business owner. If you can master the interpretation of income statements, deeply understand the balance sheet, and find a management team that acts like true fiduciary partners, you have won the analytical game. But investing is not purely a game of mathematics and spreadsheets. It is, above all else, a game of emotional intelligence and human psychology. You only have one enemy left to defeat, and that enemy is usually staring back at you in the mirror. Buffett's mentor, Benjamin Graham, introduced a beautiful allegory in his 1949 masterpiece, The Intelligent Investor that remains the single greatest framework for understanding the stock market ever created. He asked us to imagine that we own a private business in a 50-50 partnership with a man named Mr. Market, Asterisk, asterisk. Mr. Market is a very accommodating fellow, but he suffers from severe, untreated bipolar disorder. Every single day, without fail, Mr. Market knocks on your door and offers you a firm price at which he will either buy your half of the business or sell you his half. On some days, Mr. Market is euphorically happy. He is reading positive news headlines, the economy is booming, interest rates are low, and he sees nothing but endless sunshine and infinite growth. On these manic days, he offers to buy your half of the business for a ridiculously high premium price. On other days, Mr. Market is severely, clinically depressed. He is terrified of an impending recession, geopolitical wars, inflation, or supply chain breakdowns. He is convinced the world is ending. On these depressed days, he is desperate to flee, and he offers to sell you his half of the business for absolute pennies on the dollar. A renter lets Mr. Market dictate their reality. If Mr. Market is depressed and shouting that the sky is falling, the renter assumes Mr. Market must know a secret they don't. The renter panics, accepts the lowball offer, and locks in a massive, permanent loss. When Mr. Market is euphoric, the renter gets severe FOMO, the fear of missing out, and buys more stock at the absolute top of the market cycle, ensuring terrible future returns. The renter is a psychological slave to the manic depressive partner. But how does a true owner handle Mr. Market? An owner ignores his emotional mood swings entirely. Because the owner has read the income statements, studied the balance sheet, and evaluated the economic moat, the owner knows exactly what the underlying business is intrinsically worth. When Mr. Market is euphoric and offering a ridiculous premium, the owner might quietly accept the offer, sell the shares, and realize a massive profit. But more importantly, when Mr. Market is panicked, terrified, and offering shares of a phenomenal, cash-flowing fortress of a business at a massive, irrational discount, the owner does not panic. The owner smiles, opens their wallet, and buys more of the business on the cheap. As an owner, you must internalize this profound, life-changing truth. You do not let the stock market instruct you. You let it serve you. The market is not a wise teacher. It is merely a blind pricing mechanism. It exists solely to offer you opportunities, not to tell you if your fundamental analysis is right or wrong. Your deep analysis of the business economics, the strength of the balance sheet, the durability of the cash flows, and the integrity of the management are the only things that tell you if you are right. We have thoroughly covered the financial mechanics, the structural moats, the rigorous management evaluation, and the psychological warfare of investing. But there is one final, agonizing step to thinking like an owner, and for many intelligent people, it is the hardest step of all. You must master the quiet art of doing absolutely nothing. The modern financial media, the brokerage apps on your phone, and the entire ecosystem of Wall Street are built on a friction-based model that requires you to transact. They want you to believe that sitting still is dangerous, that if you aren't constantly tweaking your portfolio, hedging your bets, and rotating sectors, you are being irresponsible. But true, generational ownership requires immense, almost stoic patience. Charlie Munger famously said that the big money is not in the buying, and it is not in the selling. The big money is in the waiting. Think about the lifespan of a truly great business. Coca-Cola did not become a global beverage behemoth in a single financial quarter. Apple did not put a supercomputer in 1 billion pockets over a long weekend. Amazon did not build a global logistics empire in a year. These generational compounding machines took decades to build their infrastructure, expand their profit margins, crush their competitors, and systematically buy back their own shares. If you want to capture the immense wealth generated by these machines, your holding period must align with the business's natural organic growth cycle. If you have done the incredibly hard work up front, if you have successfully identified a dominant business with a wide economic moat, bought it at a sensible valuation during a period of market pessimism, and verified that honest, highly competent managers are allocating the capital wisely, then the most profitable financial decision you can possibly make is to sit firmly on your hands. You turn off the financial news channels. You ignore the daily ticker tape scrolling across the bottom of the screen. You delete the stock-checking widgets from your smartphone's home screen. You let the underlying business operate. You let the executives, the engineers, and the marketing teams go to work for you every single day, grinding out operational efficiencies, launching new products, and expanding the brand's reach. Thinking like an owner is not a get-rich-quick scheme. If you want quick dopamine hits and the illusion of fast money, go to a casino or day trade highly leveraged options. True investing is a get-rich, slowly, get-rich, permanently strategy. It requires the relentless discipline to read 100-page financial reports when others are reading 280-character social media posts. It requires the emotional control to lean into the wind and buy when everyone else is running for cover. It requires the profound, unshakable patience to let compound interest, what Albert Einstein reportedly called the eighth wonder of the world, do the heavy lifting for you over 10, 20, or 30 years. Once you make this complete, irreversible mental shift, once you stop renting lottery tickets and start owning real businesses, the stock market ceases to be a source of daily anxiety. It stops being a casino rigged against you. It transforms into exactly what it was always meant to be: the greatest, most accessible, most powerful wealth-building engine in the history of human civilization. The door to the boardroom is wide open. The financial statements are public record. The only thing left to change is your mindset. You are the owner now. Let the compounding begin.